tomorrow. Wherefore thou hast been focused on the latest federal developments. Salt developments by any name would smell as sweet. Hence, 'tis a glorious day on the Simply Tax podcast, as the guest today, BKD's Ted Kontopoulos and Rick Najjar, bestoweth their knowledge of the state and local tax world to answereth your questions such as, what's the latest on Wayfair that thou knowest? What dost thou do if thou receives a tax notice that thou owest? What can thou do to prepareth for the sale of the business that thou can showest? Be there other questions that thou hast? Listeneth, and thou shalt become learned on these topics and more. How now? Come without caution and be merry. Okay, so maybe I got a little carried away with this whole Renaissance theme thing here. But since brevity is the soul of wit, let's jump right in and get the latest on the state and local tax world, starting with Wayfair. There's just been an interesting time, I guess, in the world of tax, and certainly in the world of state and local tax. And really before the pandemic, which I feel like has maybe set some of this into motion and some of the maybe prospects of, if you want to call it, tax reform on the horizon here. But let's go back to almost, well, I guess 3 years ago, right, with Wayfair, and maybe just pick up there. What was the date again? Now
I'm June something, 2018.
June 21st, 2018.
Rick knows the date.
The date that'll live in infamy.
For sure. And it's almost hard to believe too that it was 2018. I don't know about you. I mean, it's unbelievable. It's been 3 years, right?
Mm-hmm.
A first question I'll throw out there is how has it and how does it continue to shape the state and local tax world?
Well, I think it's important to first understand that Wayfair happened 18 years into the 21st century. So it is a 21st century case. It's a whole generation, or roughly, if you measure generations by 20 years, we're fully there into the 21st century. So it really is the first seminal state tax case of the 21st century. What states have picked up on is they've, of course, enacted several new types of laws, mostly economic nexus laws, which give a bright line threshold to sales tax for if you have to collect and remit sales tax, which has been good. They keep it at what South Dakota's was generally, so $100,000 or 200 transactions. Marketplace facilitator laws have become very popular. I think that there's a belief out there that the result of Wayfair was intended to get at Amazon and Amazon-like companies. So states have definitely picked up on that. On the income tax front, it remains a mystery. What I originally thought was that more states would get on the what we call the factor presence wagon, where they enact bright line rules whether or not a company has to file an income tax return. Now, it's problematic, I believe, that this has remained a mystery and more states haven't jumped on the bandwagon. I'll give you an example. Just the other day, we had a financial institution client receive a notice from a Midwestern state saying, you have intangible revenues sourced from within our state, you're missing tax returns. Okay, I can look at the statute and say, well, based on Wayfair, based on the statute, yes, you should be filing tax returns. The problem with that is somebody without a tax background is looking at this and they have no conception of why. They just need to know, why should I file it, a bright line rule, or why shouldn't I file? So it's difficult to explain to them this entire history of what's happened. Unfortunately, more states haven't gotten on that bandwagon of saying, hey, $400,000 of sales, $500,000 of sales, you have to file. They've kind of just left it out there as a mystery. And of course, they want to take advantage of it selectively.
And so do you think maybe that's why they haven't really jumped on that bandwagon, as you say?
I believe so, yes. I'm not totally unhopeful. I think that in the next decade, there'll be more, but it's going to take a while. There's still some hesitancy on how Wayfair would apply to income taxes. And if you're a state or a state legislature, you'd want to say, let some other state take the chances of it in litigation, and let's see what happens first. It's almost as if who wants to be first?
Yeah, you kind of have to weigh the risks, I guess, from their perspective as well, as you said, right? Which is kind of interesting. I guess as we're kind of looking back here a bit and also looking forward on Wayfair. Now, I know the two of you co-authored what I think was a really great article on the topic in Tax Notes. And so I guess, you were talking about and discussing what you refer to as the due process renaissance after Wayfair. And I guess, what are some of the takeaways from the article and the points that you made?
First, before answering that, just again, on behalf of Rick and I, thank you so much for this interview, having us. For folks at home, the microphone provided was from Damien. He's an excellent host. We're grateful to be here and for you to have us. But to get back actually to answering your question, what are the takeaways and points made in our Tax Notes article about something that we called the due process renaissance? I'd say there are like three takeaways, of which, there are a couple of like points that those takeaways rest on. So the first takeaway being, as Rick hinted at in the first question, that states are lowering their nexus threshold for when a non-resident taxpayer becomes subject to income and sales use tax filing returns. The second is that, again, kind of linked up to this first takeaway, that the states are increasing their enforcement of these lower nexus thresholds against non-residents, primarily in sales use, but a couple of states kind of mysteriously are venturing out to do this for income taxes as well. And the third takeaway would probably be that non-resident taxpayers will probably rely more and more on the due process clause-based defenses rather than the commerce clause-based defenses. And again, these three takeaways rest on like three main points. First, there's more digitalization in the economy. So there are more companies with websites and applications that create a remote or like a virtual presence, with two kind of, opposite results. One, for businesses, they have unintended tax exposure. But on the flip side, there are additional opportunities for states in the sales use as well as the income tax realm to sort of enforce and get money from these companies with websites targeting their in-state consumers. The second point is just that the old Commerce Clause defense was less viable. The U.S. Supreme Court changed the first prong of the complete auto test, which used to just require, the three Ps under Quill. You had to have people, payroll, or property to create substantial nexus to a taxing state. But what Wayfair did was expand this prong beyond just the three Ps to when a taxpayer, quote, avails itself of the substantial privilege of doing business in a state, which is a little amorphous, with the results being that virtual presence may create substantial nexus, but that physical presence still likely does create substantial nexus. And so, the three main points, from digitalization to the old Commerce Clause defense being less viable. The third, last point, just that the minimum contacts-based defense, especially for virtual and remote non-resident taxpayers, just looks a little bit more appealing. This argument is that the taxpayer lacks a minimum contact with the state, and so it doesn't have any notice on whether to file a tax return there, much less pay tax there. The result being that taxpayers have a little bit more predictability with these defenses, because minimum contacts is a yes or no question. Do you have it or do you not? And there's a large variety of arguments that taxpayers can make. So there's a great deal of creativity that can be employed depending if the taxpayer is a traditional multi-state operator or more of a stream of commerce, marketplace facilitator, virtual remote non-resident, as Rick kind of hinted at in the first question. Again, those three takeaways, lowering nexus threshold, increased enforcement, and more reliance on the due process clause-based defenses instead of the commerce clause-based defenses, because it's just easier to defeat from a taxpayer perspective and harder to defend from a state perspective.
I'll ask you kind of follow along here, Ted, and to say kind of with that, have you been surprised at all about, I guess, the response in the last 3 years, or anything that would surprise you as we continue to see the states digest this and try to implement or not implement aspects of it?
It's kind of hard to say because litigation is a years-long process. It typically has a lead time. So, the results from Wayfair in 2018 would start to peak when states start to enforce the Wayfair related provisions that they enacted. So we're starting to see more litigation right now. And I'd be just a little surprised by how Rick hinted at the trend that states are a little bit hesitant to enforce some of their new income tax related Nexus provisions. Like they have a desire to enforce it on one hand, but on the other hand, as Rick said, there's kind of a little uncertainty where states don't want to be the first, and there are only some of the more desperate states who need revenue that are of the mindset, we need to get this revenue, and so we'll chance it. But whether or not the taxpayer defense of the due process clause based on the minimum context defense prevails remains to be seen. And so it's sort of a great deal of excitement and enthusiasm for seeing whether those defenses succeed against these newly enacted state taxes. But with litigation, as I said at the beginning of this, it's a multi-year process. So, we have to wait a couple of years to see how it turns out. But since publishing this article, there have been a couple of articles coming out with anecdotal evidence suggesting our prediction is right, which is flattering for us. But I think that Rick and I would probably say there's still a lot of uncertainty to sort out as well.
And I know, Rick, earlier you kind of mentioned in your example, kind of the income tax implications here that might be in some of the uncertainty there. So I guess we look at the future of Nexus with that in mind. What are you hearing? What are you seeing, I guess?
Well, there's some bright spots. Louisiana just had a case involving Jeopardy, the TV show, with royalty rights. They sided with what our ultimate takeaway from our article was. But in general, if I had to say what the future of Nexus would be, I'm pessimistic.
Okay. All right.
I'll go into what both camps of people sort of think. One of the biggest things with Nexus has been Public Law 86272, which applies to merchants and manufacturers or anybody who's a seller of tangible personal property, that they don't have to file an income tax return if they stay within certain boundaries. This law came out in 1959. That's when it was enacted. Then a few years later, Congress published a report that is like a 2,500-page report. It discussed, we need more bright line rules with Nexus. We need to make it more predictable. That was almost 70 years ago.
My goodness.
So
yeah, I was sitting there doing the math. I'm like, that was, we talk about being a decade into the 21st century. Yeah, that goes back a ways there.
So the people who are in the pessimistic camp, we have the luxury of being right for all these decades, that you're not going to get any movement from Congress. They're not going to step in. The fog is not going to be lifted. But on the bright side, there's a first time for everything. You never know. What I also find very, very fascinating is the rise of digital products. So what do I mean by that? Digital music, movies, anything that would have been in a tangible medium at some point in time is now totally in an intangible medium, an electronic medium. When you're looking at PL 86272 and why this is important, is PL 86272 only applies to sellers of tangible personal property. Does not apply to service providers or sellers of intangible personal property, with Virginia being the only exception to this. What used to mean tangible personal property back then in 1959 has changed. One of the fallacies people make is to think, well, if it says tangible personal property, that's what it means and that's what it will always mean. It is true there's a fixed meaning to what tangible personal property is, but nonetheless, if the phenomenon didn't exist at the time, you can draw an analogy. So whether or not Congress wants to change it, or if it's litigated in the courts, there's a real argument there to say, I'm a seller of digital products, but really I'm a seller of tangible personal property, and I should be protected, which would actually broaden the scope of PL 86272 and would be more predictable and a better, more favorable for taxpayers.
It's interesting. It's certainly to try to extrapolate and put things in context of that didn't even exist at the time. But all right, I've got to ask you another favorite question here before we get on to some of these other questions.
Dost thou wish to find out more of the favorite things and learn more about Rick and Ted? Please watcheth and listeneth to the Beyond the Numbers video on our Simply Tax YouTube channel. Backeth to thee, Damien.
What would you say the last thing you frequently listen to on Spotify or your favorite digital music medium? Rick, we'll start with you.
Well, I'm a big fan of audiobooks.
Okay.
Of course.
All right.
Of course, Rick
but
says
but
that.
I'll make an admission. It was AC/DC.
All right.
I was waiting
Solid.
for this.
Yeah. Okay. I definitely frequent the AC/DC and I get a little energy, you know.
Yeah.
Went out for a run this morning. Actually, AC/DC didn't make it this morning. I was trying to maybe keep it as a calmer run, but yeah, no, AC/DC is a favorite on mine as well. So very cool. Ted, what do you frequent?
Is it, what do we listen to on Spotify that's like music specific, or is it when
Either
we
way,
listen to Spotify?
anything is free game because we're since we're on this just topic of digital music and digital products and what that might mean. Yeah, what do you think?
I'll resonate hopefully with a lot of sports fans here. I am only in a couple of fantasy football leagues with my cousins on one hand and my family friends on the other hand. I've been listening to this podcast hosted by an ESPN show called Fantasy Focus Live, led by Field Yates, Stefania Bell, Daniel Dodd, as well as Matthew Berry. They analyze, I love analysis, obviously. That's why we write these things or we're here analyzing state tax and local tax, right? They provide great analysis on things to consider, differentiators across all the different positions from injury concerns to depth chart placement. So it's good to listen to at the end of the day after logging off from work, and not during my workout though. Unlike you, Damien, I'm usually on a fixed machine, some fixed equipment. So I do a lot of my reading on international politics and developments abroad, sometimes tax as well during those times. But
okay, there you go. Yeah, no, good stuff. But I guess breaking down things here a little bit and analyzing things, especially when there's a lot of information, a lot coming at you. It's been a busy, I guess we'll call it 18 months or so, certainly from a federal legislative perspective in response to the pandemic. But obviously we've seen a good amount from the states and localities as well. So what do you think businesses and their owners and executives should know about some of these developments?
That's a great point, Damien. There's certainly been a ton to cover, and there's unfortunately not enough time to cover all of them. But I would say the developments that businesses and their owners should know primarily depends on the category company that they are. And I broke this down to Rick's point, kind of like an arbitrary analysis perspective, with some overlap between companies that have multi-state operations, multinational operations, and sort of like a catch-all category. So for companies that conduct business across multiple states, I'd say the biggest developments relate to allocation and apportionment. Allocation and apportionment, of course, the amount of expenses or sales, property, and payroll that are sourced to a state and locality and therefore subject to state and local income tax. The notable developments to know for these multi-state companies, first, that the overall formula for apportionment continues to change, but tilted in the direction of more focus on a single or weighted sales factor, meaning if your company derives sales but doesn't have a lot of property or employees in a state, that they will have to likely pay more tax to those states that they have greater sales in. And on that note, the second notable development is that for the sales factors specifically within the apportionment formula, there's a greater and continued adoption of what's known as a market-based rule for sourcing fees. So in the past, you would source your fees or your sales for certain services, intangibles, and products based off of where the cost was incurred to perform those services or to manufacture those products. But now there's more adoption to the market-based rules, which says that you source it based off the location of your customer rather than where your corporate headquarters is or where the manufacturing facility is. And states from Alabama to California, Texas, and New York have all within the last year continued to adopt these rules. So, with respect to the next category of companies that conduct business across multiple countries, the biggest developments relate to how states are addressing or, on the other hand, neglecting guilty conformity from the 2017 Tax Cuts and Jobs Act. Rick and I actually just published an article on this very topic in the Journal of International Taxation. And for those of you at home unfamiliar with guilty is known as global intangible low tax income. It's essentially a deemed minimum tax payment that companies have to make if they own certain percent interest in a foreign corporation. And states are typically prohibited from fully conforming to the guilty rules because guilty is a little discriminatory in requiring companies that own foreign subsidiaries to include those profits in their income, even if the profits don't actually go from wherever the foreign subsidiary is, let's say like Cyprus, back to the US. Whereas there are no such deemed inclusions for domestic entities that don't, repatriate their or move their profits from state A to state B. A lot of states are prohibited from conforming to this rule because the Foreign Commerce Clause, found at Article 1, Section 8, Clause 3, and the 1992 Kraft v. Iowa case say that states cannot discriminate against foreign commerce more than, or relative to domestic commerce. So like the notable developments to know for these multinational companies is that states are just taking different approaches for whether or not to conform to guilty and to chance a Foreign Commerce Clause challenge. So like on one side, Nebraska and New Jersey seem to be forcing taxpayers with guilty, so taxpayers, multinational operations, to include this as part of their state taxable income. Whereas on the other side, certain states like Texas and Alabama are allowing taxpayers to exclude this federal guilty for state tax purposes. The takeaway from multinational companies trying to figure out how to, deal with guilty is to consult with your SALT advisor or your state and local tax advisor for whatever rules are applicable to operations in the states that you operate in. But, the last kind of catch-all, I don't want to take, too much time in answering this question, is for all companies, including those that are neither multi-state nor multinational, where the biggest development relates to income tax collection. So a state Department of Revenue's attempts to assert deficiencies on resident or non-resident companies. And this is a little biased by my tax controversy experience and seeing this on the ground, where generally Rick can attest to this, we're seeing increased enforcement by departments of revenue to collect deficiencies or perceived deficiencies from both resident and non-resident companies. And as Rick, pointed out, lowering the threshold for what it means to do business or making it a little bit more mysterious makes it more likely that a company may unintentionally establish substantial nexus or have a filing obligation. And if they don't, the notable development is that a lot of departments of revenue are enforcing these new rules and lowered thresholds to get tax that they feel is more fairly deserved by them. Again, the latest developments depend on if your company is multi-state in operations, multinational, or neither. And your three concerns are allocation and apportionment, or guilty, or just income tax collection efforts to deal with.
We managed to work in the it depends function or feature here of state and local taxation. But I guess real quick on that tax controversy hat and putting that on, because obviously that's one you wear. And any just advice, because I've certainly seen that as well, just this increase in volume of notices and assessments and so forth, which can be very intimidating to businesses and business owners. What's the first step? What's the advice that you would give to someone on the receiving end of these notices?
So if we're talking about the timeline of controversy and we're in the middle, away from the prevention step and closer towards you already did something and you received a notice, what do you do from here? Some of the real questions to ask are essentially whether there's a basis for the state to assess those taxes against the taxpayer. And of course, the lawyerly answer is, it depends. What's the penalty amount? Does the company have a big enough presence in the state where it needs to preserve a good relationship? And so is it more beneficial for the company to take a long-term view and pay the, short-term price of whatever the assessment is and agreeing that they're going to have this beneficial relationship with the state on a mutually beneficial understanding? Or does it want to fight the state and truly believe that it doesn't have, a presence there? And if the penalty is large enough and the taxpayer's facts are good enough, like they aren't doing anything in addition to target a state, or they're not expecting substantial sales volume in a state, then there's a greater set of facts to make the due process clause based argument that the state's attempt to tax the non-resident company is a violation of their right to notice and their right under the due process clause in the US federal Constitution's 14th Amendment. So to kind of briefly summarize on the it depends decision tree, what's the price of the penalty? Is there a long-term interest in preserving a relationship with doing business in that state's market? And how good are the facts for challenging the state's attempt to collect income or sales use tax based off of the non-resident taxpayers' presence in the state or lack thereof? They just have a website or like a phone application that people can download for free and use within the state.
I love that. Great summary there. And I like also referring to it as the decision tree, because it absolutely is. And
Right.
I'll say on my decision tree, as I kind of work down there, a lot of times okay, where am I calling Ted in here and bouncing this off of him? So you're on my speed dial whenever those things are kind of popping up. But speaking of the pandemic in the last year, is this issue that comes around remote working. It's one that we've talked about on the podcast before, but it seems just kind of continually be developing here. So I guess maybe, Rick, I'll kick this one back over to you. What are we seeing, recent observations and things to keep in mind here from a remote workforce perspective?
The question really is, what does it mean to work somewhere? I'll give you an example I've seen that's really fascinating. These days, there's robotic surgery where physicians can perform surgery remotely.
Wow.
So let's say you are going to perform robotic surgery, you're the physician, and you live in New York, but your patient is in Texas, and you're going to do the surgery virtually. Where are you working?
Great question.
It's an interesting question.
Yeah, you kind of stumped me here a little bit. Yeah.
I feel like there's a trick.
So, with remote working, the whole question is how are you going to tax labor income, the income people make from their day-to-day jobs, salaries and wages? And the rule has always been simply, where do you perform the work? That is changing in the sense that if you can perform your work virtually, is it where there's a headquarters office that you ultimately report to? Is it your basement? I think we're going to have to figure this out in an uncomfortably fast way, because I live in a jurisdiction, Kansas City, that levies a personal income tax, what they call an earnings tax, for the work that I do here in Kansas City in our office. If I decide I'm going to work outside the city limits permanently, my tax base goes away. And so do several other people that don't work here, if they have that option of working from home. What do major cities, Kansas City, New York City in particular, which has several commuters, how are they going to compensate for this deficit? Also, states where people commute in or out, border states, again here, Kansas and Missouri. Of course, there was the Supreme Court. They denied cert, but Massachusetts and New Hampshire. What is this really going to mean for revenue budgets? And I have seen right at the very beginning of the pandemic, there's an Arkansas ruling saying that a remote worker in Washington, the state of Washington, where there is no personal income tax actually, that did total virtual work, their work was performed in Arkansas and subject to Arkansas tax. That's an interesting argument to make. Here's the problem with that. If you're going to say where it's performed, or from a virtual sense, does that mean that the people who actually do work physically in the state, you're not allowed to tax them? So if you're going to choose one, you have to stick with one or the other. You can't have it both ways, and there's constitutional reasons for that. But I think the day of reckoning is coming. I see article after article that Remote working is very popular. Employers are offering it at least a few days a week. It's going to have a real impact on budgets in the next few years, I think. One other thing that people don't consider is, let's say they do find a way. We have these new laws and they're going to take a side. They say, if you're working virtually, we're going to source your wages to the headquarters you report to, which are in our state. Okay, that's a start because it's a bright line rule. It gives us predictability. But one of the problems that you're going to run into with this is the more we open up, I'll call it a national, even international labor market for people. If you want to work for a company headquartered in New York, but you want to live in South Dakota, there's going to be a settlement with wages and salaries, meaning you're not going to get a salary that's incredibly high like New York because the cost of living is so high, but you may be able to get a higher salary and wage than you would just working for a company that you normally work for in South Dakota. So again, there is going to change the tax base and the flow of revenue into localities.
Sorry to interrupt you, Rick. I'm seeing a similar issue with respect to remote work and sourcing for on the international front too, having fielded a few questions from companies where, employees who typically work in, let's say, like New York are considering working in, I don't know, the Virgin Islands or, Puerto Rico, or name your favorite Caribbean country, maybe Aruba. And similar questions, where their wage would normally be subject to like the city or the state's local income tax or wage tax. And it's a really important consideration, principally the multi-state, but secondarily, like internationally, same issue, same patchwork of incoherent responses. Understandably, too, this is not enviable work to be a policymaker to deal with this.
No, it definitely is not. And it really gets into an age-old debate is, where is income produced? And I know you had brought up why more states are moving for business taxes towards weighting the sales factor or going to a single sales factor entirely. That is a new phenomenon. The sales factor was always just a way to give states who have something unique about their market. I think of Florida as one for tourism.
Mm-hmm. Or Chicago for pizza.
Or Chicago for pizza. But any economist in the world would always tell you, well, income is produced where labor and capital come together. So this role of a market is a new phenomenon, and now that it's becoming everything is certainly interesting, and it does give a lot of power to states like California, who have the biggest population. So
do you think, Rick, like the shift towards single sales factors, or perhaps even just like the weighted sales factors, kind of reflects the dynamics with, or the troubles with getting revenue from losing employees that would otherwise be included in the payroll factor because of virtual work? Like the payroll factor is lower because people work virtually, and to overcompensate for that, among other things, like the unique tax base or consumer base, tourism in Florida, enormous market in California, tech in Texas, pizza in Illinois or Chicago, Do you think that the challenges involved in taxing remote work have anything to do with driving the impetus towards more single sales factor apportionment formulas or weighted sales?
yes, I think there's two things that are driving it. If you move to a single sales factor system, I don't want to say it's underhanded, but it is a secretive way of trying to attract property and payroll into your state because it results in a lower tax bill at the end of the day. So it's almost like a hidden incentive to lure jobs back to your state, which is ultimately what policy makers and politicians are judged on, or it's a tremendous part. The argument is that among the states and the world in general, the role of the US and the world in general is that we've become a service-based economy, whereas raw labor power and factories and manufacturing just doesn't carry the same weight that it used to. So it makes sense now that we look and see, well, who has the market for you to exchange with? That's where income is generated.
kind of mentioned at the top here the fact that, we're kind of seeing this this buildup in Washington on the federal side, that may bring higher tax rates. And as a result of that, particularly because of the capital gains changes, that the proposals, I should say, that are out there, I'm hearing a lot of interest in M&A activity, maybe exiting a business from a succession plan a little, if you're looking at in the short-term horizon, sort of locking in the rate, now, or those sorts of things. And there are frequently, and this is a soapbox I sometimes will get on and at least highlight, to say that there's frequently issues that can come up from the state and local perspective. So maybe Rick, back to you on this one. What advice or considerations or tips would you have for those that are contemplating an M&A transaction or gearing up for one from a state and local tax perspective?
Right. So I'll start off by saying the more that Congress, or any of the states for that matter, opt to raise rates, it creates a problem public finance experts call of neutrality, which means there's always more planning opportunities, because the higher you raise the rate, the more deductions, exemptions, and things of that sort that you have to write into your tax code. If you want to pick and choose who should pay those very, very high graduated rates, that's what you have to do. One thing that's driving up interest in the M&A transactions in SALT is the $10,000 SALT cap. A lot's been going on in the political sphere lately on that, whether or not we should do away with it or we should raise it. Even if it's raised, let's say from $10,000 to $50,000, that'd be a big impact for most people. It's just that with pass-through entities that we deal with so frequently, the income amounts, and it's not a cash distribution, are just so large that it's a drop in the bucket. So what I think is that there's definitely planning that we can do, because this has also been going on for several years and that's been eroded. And if you have the sale of a business, it used to be you could just source that tremendous gain that you'd have. Let's say it's a startup and you're cashing out from the startup. You could source it to where you lived. So people were always driven to live in Las Vegas, Nevada, Florida, and Texas, places where there's no personal income tax. They'd relocate, they would retire there. That has since gone away in recent years, and it's been now exacerbated by this limitation on the deduction for state and local tax. The good news is there's definitely planning opportunities we can do where we can get to those old-time results.
Maybe could you unpack one or I guess a structure maybe that you would consider in that context?
Yeah, Rick, like what we talked about in either the Florida Guilty article or the upcoming California article be helpful here.
Sure. So, well, I'll give one of my favorites actually lately. Let's say you want to cash out your startup and you're going to decide that you need to sell the business, but the buyer wants to buy your assets. Usually they want to cherry pick the assets out of the business because they don't want to take on certain legal liabilities. Well, there's a way to do that where we can structure the transaction where the buyer will be able to do that. Plus, you can source the gain, the resulting gain from you, the capital gain, as a sale of stock. And you can source that to where, if you decide to stay where you're living, or if you want to relocate to a lower income tax jurisdiction. Now, this also has tremendous impact given that I think the top marginal California tax rate is 13.3%. That's pretty high for a state. I know New York's at almost 11, so 10.9%. So even if you have operations in these states or sales, as we just said, and you have Nexus, which it's easy to get now, you're going to owe a tremendous amount of tax on that gain if it's not structured properly. And we can always help people with that here. There is also, as Ted had mentioned, for ongoing operations, if the SALT cap is a concern and you're a pass-through entity, we can do things that would essentially transform some of your income into foreign source income and create an extra deduction for you. And that's a year-over-year benefit.
With that in mind, and maybe backing off globally from a state workaround perspective, because I know we've seen a lot of that, even in the state that Ted and I find ourselves in Illinois recently adopted a workaround, but obviously a number of others have as well. And there's probably a lot to unpack there. But any observations or thoughts to mention on the topic of salt cap workarounds?
There's a salt cap workaround. There's a model legislation that a lot of states are adopting, but they're doing it with small variations in that. So it's not going to be a uniform approach. And we'll have to see if Congress raises or they lift the cap. Let's say they totally lift the salt cap. All this will be in vain. So that is something to consider. Also, companies need to consider if they're filing a composite return for their pass-through entity, if they keep wanting to do that, or what the impacts are, because usually you can do one or the other. You have to stick with the composite filing, and you have to deal with the salt cap, or you can do this pass-through entity tax election, and then you don't have to deal with the salt cap, but you lose some of the benefits of filing a composite return. Just other food for thought is we've been down this road before in Kansas, long before the salt cap was even a thing, and it floundered. Now, it's a different world we live in with the salt cap, but just something to keep in mind. So that legislation was ultimately repealed. It didn't last very long, maybe 2 years.
Very interesting. And again, like you said, it even is impacted by this windup that we're going to see this fall and all the activity, because I'm kind of hearing the latest there is perhaps there's a block that's saying, hey, let's get that salt cap repealed, or we're not going to be on board. So we'll see, but certainly a lot to think about. Go back to your comment there earlier, Ted, right? It depends decision tree, I guess you have to develop for yourself here. So this was a fun conversation. We covered a lot of ground, although certainly any of one of them, I feel like we could have gone and turned into an entire conversation in and of themselves. So with that in mind, maybe just a closing or final thought you'd leave listeners with here. Ted, maybe we'll start with you.
If you're a taxpayer and you're trying to ask the question, what are we looking for as we head into the year end? Obviously, pay attention to any federal tax rule changes from the recently passed budget bill. I know we kind of covered some of those concerns, from rates, regular income tax rates, to the capital gains rate, but also in addition to those changes, any COVID-related relief measures continuing or ending. And, small plug for the tax controversy, in addition to Damien's very kind words, aggressive tax enforcement. Rick pointed out the problems that a lot of revenue departments or revenue commissions, however it's phrased for the state, have due to remote work, among other things. And as a reminder, 2022 is an election year. So, there's also a political motive to show that there's a proper amount of state funding and everyone's paying their fair share or not. But I think those three takeaways: any federal rule changes, any COVID-related measures continuing or ending, and aggressive tax enforcement are good things to watch for and be mindful of to minimize risk.
Good points. A lot of balls to keep your eye on, I guess we'll say. But Rick, what would you say? What would you kind of leave everybody with here?
Well, we can't read the tea leaves, but we're going to try. There's a lot we can learn from the history of state tax, which is getting extensive. It's still a brief history. It's not as much as what's gone on with federal tax. If you're careful and you can plan into it, if you make it worth your while, there's definitely financial benefit to understanding state tax and engaging somebody to help you understand it and plan through it. We'll see what the next 5 or 10 or 20 years brings. I hope it's, as I said earlier in the podcast, I'm a little bit pessimistic, but for all those who disagree with me, I hope I'm wrong.
I'd like to once again thank Rick and Ted for sharing their great insights today, and invite you to check out the show notes of this episode, available at bkd.com/simplytax, for links to articles and other resources where you can learn more about the items we covered today. And of course, to find out how you can contact Rick and Ted. Have a question for me? You can find me out on LinkedIn and on Twitter at Damien Martin CPA. You'll also find me on Instagram at TaxDad and on YouTube by subscribing to our Simply Tax YouTube channel. And finally, we'd really like to know how we're doing and would appreciate a rating and review on Apple Podcasts, and if you subscribe to the podcast. I'm Damien Martin. Thanketh thee for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.